Yeah, go.
Yeah, all right. So I'd like to start off by thanking everyone for attending tonight. It's really great to see everyone here at our FinTech panel. To tell you a little bit about who we are, I'm Jason, this is Chris. By day, we run a digital project, our product agencies, Junto in August. And by night, we put on really exciting panels like the one you're about to see tonight. We do monthly events, so check with Alex or back with to see what some of the stuff we have up and coming. And I'll pass to Chris to introduce the panel and what we're doing tonight.
Yeah, so I'll tell you a little bit about format. So it's 6:30 now. We want to keep this to an hour so that if you guys want, you can head out. If not, we'll probably all hang out in the back and have some more drinks and chat. But the idea is we're going to do 45 minutes of moderated conversation followed by audience Q&A. So definitely we want to have a lot of questions. So if you think of anything, just save it, and towards the end we'll do that. So I want to introduce the whole panel. I'll start by introducing Matt, who will then introduce our guests. So Matt is both our moderator and my brother. He's also the CEO of Moves, which is an app and a business that provides financial service for gig workers, gig economy workers. So he might tell you a little bit more about that, but thank you. Thanks for all joining the State of Fintech panel.
Awesome. Thank you. Thanks for being here. And I think we were just chatting about it earlier, but I think probably there's some merit in doing these things more recurringly, specifically on FinTech in a city like Toronto. There's a lot of businesses building some cool stuff that we're going to get into. A little bit more about me and my background. I lead a business called Moves. We're based here in Toronto. We operate in the US. We're primarily today going to talk about the Canadian market, so we won't talk a ton about what we're doing. But there is also a little bit of a story of like more and more Canadian FinTech companies putting their eyes in the US market, and we'll touch on that a little bit. And as Chris said, we specifically serve gig workers. So you think of Uber drivers, DoorDash couriers, and sort of banking services and financial services for this audience. Super excited about the panel we have today. I think a pretty good cross-section of like what FinTech is in Canada, what types of businesses and sort of players exist in this space. Dom, to my left, is with a company called Flinks. Flinks, I'll let him get into it a little bit more, but broadly speaking, a very important sort of data layer for FinTech companies to be able to access things like banking information, to be able to open up other services to customers. So they've been incredibly successful. They had a big exit to National Bank last year, 2 years ago.
About a year ago, yeah.
About a year ago. So a huge success story for the Canadian FinTech ecosystem. Karim to his left, who's a general partner at Luge Capital. Luge is one of the most active, specifically FinTech investors in Canada that only looks at this space. And Rob to his left, who's the CEO of Float. Float has been one of the, I'd say, probably leading B2B FinTech companies built in Canada in the last couple of years, offering right now sort of corporate spending and a bunch of other sort of financial services tied to like small businesses. He'll get into that a little bit more, I'm sure. But they had a pretty breakthrough fundraising last year that caught everybody's attention in the Canadian market. I think 30 million USD, if I remember. Yeah. So obviously turned a lot of heads for what they were building. But broadly speaking, really good cross-section. So we're going to talk a bit about what companies are doing in the FinTech category, what FinTech means. Not everybody in the room comes from this space. But also how investors think about this. What are the challenges in a current market? The VC market's going through a lot of turmoil. And what that means for FinTech companies, I think will be an interesting perspective from Karim. But maybe I'll start really quickly with what is FinTech. And as the name sort of implies, it's sort of the intersection of financial services and technology. So you think of products like Wealthsimple, a darling in Canada that everybody can think of as like an obvious example. But this is a growing segment where people are trying to build out more modern access to financial services for segments of the economy, and then all the underlying and supporting infrastructure needed to support those services. So, at the consumer or business front end, you'd think of products like Float, products like Wealthsimple, products like Neo, and others, and then underpinning these businesses, a whole bunch of new infrastructure that's getting built to empower and enable these companies. So, FinTech investors will often operate sort of throughout that stack, whether they're going after B2B businesses or B2C businesses or effectively infrastructure businesses. But why don't we do a quick little across the panel, see if I missed anything about your intros or about what you do specifically, and then I'll come back for our first question. But one of you
kind of hurts the neck to look up at.
Yeah, sorry. If it were up to me, I'd be on your level. I don't mean to be up on a pedestal, but people can see me at least. Go ahead, Dom.
Yeah, thanks for the intro, Matt, and happy birthday, by the way.
Yeah,
right on.
I was like, yeah. I was like, maybe he put a fake one in LinkedIn to protect his personal information, so that's why I was unsure, but happy birthday.
I couldn't imagine anywhere else to celebrate.
Coming from the data aggregation guy.
Yeah.
There we go.
Yeah, he knows my birthday. He's been looking at my bank account.
Yeah, exactly. That's how I really know. It's not LinkedIn. So, hi everyone. Glad to be here. Dominique, Samson, so Vice President, Corporate Affairs for Flinks. So my role is basically handling the relations with both government and the industry. The label I would give to our company is we're basically an open banking company. So if you've heard about that term, anyone has never heard the term open banking? Everyone is at least somewhat familiar? Okay, cool. So we're an open banking company. Like in our original business line, so we were founded in 2016. Our original business line was basically providing a connectivity widget to fintech companies so that they can allow their users to easily link their bank account to the app and then power whatever their product or service is with their users' financial data, always with the consent of the user, obviously. Since then, more recently, last year, we've opened a second business line with the aim to basically accelerate open banking, and it's addressed to a financial institution audience. We basically help them build open APIs, so to allow the data transfer channels to be more formal, because historically it's all been based on screen scraping, meaning it's a robot that gets into your bank account really and pulls the data for you. And now we want to help banks move towards the future with APIs, which are more formal channels where the user has more control. So that's Flinks in a nutshell.
Karim.
Cool. Hey everyone, I'm Karim. I'm one of the general partners of Luge Capital. So we're an early stage fintech focused venture fund here in Canada. We invest in both Canada and in the US. We typically come in seed and Series A stage, and then we follow on for companies that are growing. Flinks was actually our very first portfolio company back when we started the fund in 2018, and so we were proud investors straight through to the exit in October last year, and I was lucky enough to sit on the board of the company through that time. So we've got 20 companies in our portfolio. Flinks was one of them. We've got 2 exits, including Flinks. And we've been at it since 2018. For what it's worth, my background is in engineering, finance, and law. Spent a bunch of time in fintech companies as a developer, as a product manager, and then more recently in venture and in M&A. I was running corp dev at a company called Zoom, took the company public on the NASDAQ, and then ultimately sold the company to PayPal back in 2015. And then I ran M&A and ventures for PayPal out of Canada and the East Coast of the US for a few years before starting the fund.
That's it. Awesome.
Hey everyone, good to see you. I'm Rob, I'm the CEO of Float. Float is a corporate card and spend management platform for small and medium-sized businesses. We basically help businesses get access to the best version of a corporate card they've ever had. So really high limits, super empowering, and comes with software that really enables your team, your finance team, VP Finance, CFO, and broader team spend on behalf of the business through great software workflows. So for example, requesting to spend money on an event like this, you can do it through Slack, your manager can approve it, will instantly issue you a single-use Visa card virtually that you can use for the event. We automate receipt collection, we automate all the approval hierarchies that most businesses tend to have when it comes to expenses, all kind of with the vision of eliminating expense reports, which everyone hates. And prior to this, I spent 5 years at Uber on international expansion, and then was later a general manager for Eastern Europe and Canada, and prior to that worked in private equity investing for 5 years in Canada.
Awesome. So I'm curious, I think one of you already mentioned open banking. I think it's worth us digging into that a little bit, but in the broader context, I think people who live in Canada maybe take this for granted, but the Canadian financial services industry is quite different from the US, and it impacts the way we think about the competitive landscape as companies, also some of the barriers and obstacles that maybe make it difficult for us to operate in Canada, but also some of the separately obstacles that might make us rethink not operating in the US. So what is it about the Canadian market that's either attractive or a deterrent if you're a Canadian fintech company? Karim, I'd really love to start with your perspective as you invest across both countries. Do you like to see companies focused on the Canadian market as a market strategy, whether they're based here or not? And how do you sort of navigate the pros and cons of both countries when you're thinking about market opportunity?
So the short answer is no. We don't like companies that are only focused on Canada for the long term. There are some specific exceptions to that rule. Real estate being one of them. I was just telling a gentleman over there that real estate is one of the markets in Canada that's actually large enough to build a venture-backable business, so long as your revenue model is tied or correlated to the size of the market. But generally speaking, the Canadian economy is often meaningfully smaller than the total opportunity available to you. The problem with being a global everything company initially is that by nature, fintech is default local. And so what I mean by that is you're typically subject to local regulations that are often not standard from country to country, and even within a country, there are differences between jurisdictions. Dealing with payment rails are different between countries and often don't talk to each other. Dealing with how you do things like KYC and onboarding. KYC is verifying somebody's identity. This stands for Know Your Customer. So all of these elements are different in each country, typically speaking. And so what we find is companies will start in Canada, demonstrate some local success here, making sure they're following the local regulations, integrating into the local payment system, use local currency like Canadian dollars. And then once they can prove themselves, they will put meaningful effort into expanding into a second geography. And that's a non-trivial effort, going from geography of 1 to geography of 2 and then to geography of n, because of all of these different regulatory issues, multi-language issues, multi-currency issues. So what I always guide founders to do is to build their platforms so that it is extensible to other geographies, but start out in Canada as a local sort of first case, prove yourself, demonstrate that the business works, make sure the fundamentals work, make sure that your unit economics work before then you go out into other geographies.
Is that the story of Float? Is that how you think about sort of the future opportunity? You guys are a Canadian-only business today, right?
Yeah. Yeah, I mean, we go back and forth on it. We don't have any plans to expand today. We just operate in Canada. I think that the fintech market, if you take a long-term perspective in our business, we feel can be quite large in Canada. I mean, we have generally two options available to us. Float can go compete in our vertical around the world, or we can expand horizontally, not too dissimilar from Wealthsimple, and offer other services to our customers in Canada. And so I think today the latter is probably our default case, but I think there is a lot of merit and focus, and you mentioned that, and I did expansion at Uber for 18 months, and even though I did it, when I finished my time at Uber, one of my big takeaways was a lot of this was a distraction. I think you have to bet the farm on winning a market, and the player who bets the farm on winning a market wins. We have competitors that put a GM and like 2 sales coordinators in Toronto. And having done that for Uber and then learned the hard way what you need to commit to market to win, especially in this market environment, which is pretty competitive, it's like a double-edged sword. If we were to expand, we would certainly do it very aggressively. We would not take a handful of employees and send them there and say like, good luck. So I think
I think I know who you're talking about.
I don't know. I think we would think carefully about it, but today it's not part of our base case. But in general, it is true. I mean, when I left Uber, I felt why would I work for a company in Canada? You got to go after the big global market, and for a variety of reasons, Float, we ended up in a different place. And
the idea being that once you've got that small or medium-sized business acquired, it's easier to maybe expand the offering, offer them more parallel services.
Yeah.
You've already acquired the customer. Now it's just like grow the portfolio of services that you can offer to them.
Yeah, and I think it's a debate you have to have about what strategically makes sense, which is itself a somewhat abstract thing, or difficult to nail down. And then what do you think your organization is good at and will do, and what are the competencies required to be successful in that business? At Uber, it was you really needed to have local operations teams. If you delegated that and you gave those people autonomy, people like me could, change regulations and all the stuff that people remember from Uber. That was all the local teams. So you have to decide, I think, what your business requires, and if you are going to do it, the mistake most companies make is to not really commit. Like if you're going to put a team on the ground and you're going to really build a business there, you need to pursue an empowered, decentralized organizational structure. Remote offices reporting into HQ don't get much done, in my opinion.
I mean, this is a good point for Float specifically. You guys are, going after Canada, winning this market as your strategy, which, it makes sense to own your market first before you even think about going into a second market. And then to your point, if you do that, do it aggressively, otherwise don't do it at all.
I think it's about earning it. It's not even a strategic imperative.
Yeah.
It's like I say to our team, once we've won Canada and we've got a profit pool here that we can use to invest elsewhere, we can do that.
Exactly.
Uber learned the hard way. You can't compete everywhere with everyone all the time. And if you're going to do that, it'd be helpful to make money somewhere. So I think that's today much more of a reality that can sometimes be overlooked if you just think about, what's the biggest market? Let's go get it.
Now Flinks has a very obvious parallel in the U.S. How do you think about the U.S. market? For those who aren't familiar, there's a very a ubiquitous platform in the U.S. called Plaid. I think by and large plays a similar role to what Flinks does in Canada. How do you think about the U.S. market?
So it's no coincidence, I guess, that Karim was on our board for some time, because our story is basically exactly what he explained. We started by establishing very, very strong foothold in Canada, and then we expanded to the US. And at first, it was very daunting because of giant players like Plaid doing basically the exact same thing as us. But what we found over time is exactly what you said. The total opportunity size remains larger, even taking into account all the competition eating up the opportunity. This opportunity size left for you remains larger than Canada. What the added competition means is that you have to find your niche, like your competitive advantage. You have to nail down exactly what it is. And in our case, it took a bit of time, to be honest. Like at first, our strategy was basically put a couple of employees on it and wish them luck, and it didn't work out at first, but eventually it did. And to the point where right now the US is a bigger revenue accelerator than Canada.
Wow. You mentioned open banking earlier. I think maybe a little bit of context, because the term gets thrown around a lot, but I think one of the big elephants in the room in every fintech conversation is the role or the barrier that the banks represent in sort of the continued innovation of the industry. I mean, Canada, no surprise to people in the room, is effectively 5 big bank oligopoly with a couple of smaller players that sort of trail behind them. It's a very different dynamic than the US market. There's a lot less sort of natural competition in the industry. And a lot of what we rely on as fintech companies, let's say if we're operating in the Canadian market, is accessing the infrastructure that the banks effectively monopolize and control. Whether it's the payment rails, whether it's the ability to issue insured accounts to customers, all of these things sort of require that you engage with a bank at some part of the life cycle of your business. You guys obviously have to play a little bit political and maybe diplomatic.
Quite a bit.
So you might not speak super openly and honestly, but I'd love to just get your perspective on where are the banks today? Are they net positive for fintech companies trying to innovate in this space? Are they still generally a barrier? Let's assume that nobody here is going to go back and report to your partners at the banks. So you can be honest, but
yeah, no, and it's fine, really. I'm used to surfing the line. I learned it the hard way at times. The first thing I would say is you cannot refer to the banks as the banks, right? Like there's different segments in the market. Obviously, you've got the big guys club, like the big 5. They will probably be the last ones to move. And it's not because they're closed-minded or anything like that. It's because, as everyone here knows, it's a concentrated market. They own 90% of it. They have the most to lose. And so, I was talking about this new product line we have where we help banks develop their open banking APIs. Like, for us right now, they're a demographic that we are purposely not targeting. They are the biggest potential clients, obviously, but I believe they will not move before a bunch of other players have. When you look at the mid-market, so the big but not big five guys, so the EQ banks, the Canadian Western banks, the HSBCs, for these guys, it's very attractive because open banking is becoming a very, very strong customer expectation. Like, people use apps like Float, Move, Wealthsimple, you name it. You can think of 1 million of them. People expect to be able to use these tools. A bank that moves towards open banking, to make it a short story, you're making it easier for them to do this and to do it in a safe, reliable way where they're in control. And the people are more and more becoming aware of that. So for these mid-market banks, they want to satisfy this customer expectation. In a lot of cases, they don't have the same big legacy systems as the bigger ones. They're more agile. It's easier for them to build an API and so forth. And so we're purposely targeting these guys. And when a bunch of them will have moved in that direction, we believe this is what's going to move the Canadian market forward. We're also doing quite a bit of lobbying work. Like, for the last 4 years, I've been at it nonstop. I believe it has minimally moved the needle. Like, Canada, we're culturally a very risk-averse country. We feel safe in our oligopolies and the stability they bring. So in my mind, policy is not the tool that's going to bring open banking here. It's people leading the charge and putting feet under the fire of the others.
Okay, I was going to try to expand on that, but maybe we move on to another topic. This is a little different for Flinks, but I'd be curious for Float in particular, and Karim, how you think about this as an investor. I mean, fintech, beyond just like the market we're in, also sort of implies that there's two plausible business models that companies are pursuing. There's financial services as a business model, and there's tech as a business model. They're not always one and the same. A lot of companies in our space that offer banking services or debit cards often start by relying quite heavily on financial services revenues, maybe with the eventual goal of like evolving more towards like tech business type revenues, SaaS revenues, et cetera. How do you think about like business models when you're evaluating a company? What's the emphasis you put on what their future revenue strategies are and how their product's going to evolve from one to the other? Or are you okay with them sort of squarely just saying, here, we're going to be a more modern financial services company?
Is that for me?
Yeah, let's start with you because you'd have a broader perspective. And then,
let's see. Like, look, we're pretty open-minded on the various business models. So it's less important to us whether the business model is categorized one way or another. And look, as an investor, this is a bit of a controversial thing because a lot of investors will say, hey, we want to see SaaS revenue because it's highly predictable. There's a lot of ways to measure the quality of a SaaS business. Me in particular, SaaS is great, but I'm equally attracted to usage-based businesses or transactional-based businesses. Why? Because with a SaaS-focused business, you're capped. You're capped at what revenue you can generate from a user, particularly if you're talking about, X number of dollars of subscription revenue per month. With a transaction-based business, if you're doing something well, the potential revenue is basically unlimited. Actually, Flinks was a good example of this. Flinks' business model was a transaction-based model. Every time you hit their API, you get charged for it. Now, there was a minimum amount that you'd have to pay, but it was effectively, the way they saw growth was on a transaction basis. And it was a phenomenal business model because they have built something that people want to use over and over and over again with high quality. So you know, we're okay with other business model or a variance of business models. The real main criteria for us is that there has to be a demonstrated path to something huge. You know, if we do our analysis and we say, okay, well, in order for you to hit $100 million of revenue, or see a path to that, or some large number that makes you a venture backable business, which by the way puts you in a particular category, we need to be able to see a path, whatever the business model is, to get there. Now, often, you know, if we see like interchange only type of businesses, we have to, that may be okay to start, but we need to see some other method to get to these like outsized returns.
And maybe,
that answer your
yeah, I think that's great. And maybe I'll pause to define a couple of terms just in case there's people not from the industry. So interchange revenue, very common among fintech companies. Effectively, every time you swipe a debit card at a machine, whether online or in person, the merchant is being charged a fee to process to accept that transaction. The interchange revenue is some share of that fee. So if a customer goes to Loblaws and swipes their debit card, the company that issued them that debit card is going to earn a fee paid by Loblaws every time that customer swipes their card.
Yeah, and that model, the way that model works long term is if the volume you guys are processing is massive. Like it doesn't work so well if you have a bunch of users who are swiping their card only a handful of times every month, and the dollar value of those swipes are really small, because you're talking about double-digit basis points, or sometimes 100 to maybe 150 basis point, or 1.5%, which is relatively small as a take rate. So the only way an interchange model actually works at scale is if the volume you're processing is massive.
I do the math every month on how much volume I've pushed through Float, and at some point Rob owes me a dinner or something. But yeah,
it all back to you. You don't really make any money, as you said, until you move a lot of money.
Yeah.
I mean, I share Karim's view. Like, I'm indifferent. I think the classification of startups or companies is sort of irrelevant. Like, are the big tech companies even technology companies, or the ad companies? I mean, there's so many ways you could slice and dice it. So for us, we don't really care. I think that we view, today Float is primarily an interchange business. 90+% of our revenue comes from interchange. We have some SaaS fees, but our perspective on our business model is that if we keep building what we're building, we see a future where Float will have not just a lot of opportunities through transaction-based revenue, but also other potential revenue sources that sometimes only present themselves once you get there. Like even in SaaS, the concept of willingness to pay, what would a customer pay for your product? We go through that process at Float, and our pro plan is $99 a month. At any moment in time, we say, well, is our product worth $100? Maybe a year ago it was $5, and in 5 years it'll be $1,000. You can make a lot of mistakes if you try to charge $1,000 for a product not worth $1,000. Doesn't mean that potential won't be there. So you have to look in the mirror often and be real about what value you're creating today, and if you keep doing that, what opportunities that can create in the future. We try to not think about that often, actually. I think it's a useful thing to think about a couple times a year and then get back to building and go, that's great. We don't want to change our prices every month. We don't want to flip our business model every month. In interchange, it's pretty easy because we have actually a contractual view into how our unit economics change as we move more volume. And so that gives us some certainty. But I do think financial services is a very exciting area of fintech specifically, or technology. As someone who worked in finance earlier in my career, I think it's something that is, in some respects, still actually really underpenetrated. Like most fintechs today don't actually provide financial services. They provide technology that is in and around financial services. For Flow, what we're personally really excited about is if we had to build a standalone business offering loans or corporate cards to businesses, we wouldn't be that excited about it. What's enabled by doing that through a technology platform, which allows us to see, for example, in real time, the financial performance of our customers. If you go to a bank today and you ask for a credit limit increase on an account, they'll probably they'll send you a PDF statement, and then they'll tell you to fill it out, sign it with wedding, and drop it off at a branch, or fax it back to them, or email it back to them. They have no visibility into your company. And so we think about how can we position ourselves to have unique insights that may give us an edge in providing financial services or lending products, which, without that edge is essentially just underwriting. And that unless you're doing something unique, is to some extent just a question of risk arbitrage.
Well, and let alone that gets into a lot of future opportunities to where your product can sort of go. But I just find it fascinating how difficult it is in your category specifically. You open a small business in Canada, which maybe people in the room have had experience with, and you want to make an online purchase out of that business's account. There's no mechanism to do it because that bank is not going to give you a credit card because you have no credit history. You can't use your debit card online, and so you're effectively completely constrained. And then it seems so obvious that you should be able to open a business and, let's say, go buy something online. And you can't do that unless you have a flip come into the equation. It's a really, really simple entry point, but it's a pain point that I think anybody who's ever opened a small business account understands pretty well, right? So, and these are not very complicated or sophisticated, insights. They're just really, really basic requirements that customers have. So it does feel like the bar is pretty low to get started in terms of fintech in
that's
Canada.
The beauty of that. That's the upside of being in Canada.
Yeah.
The bar is pretty low.
Yeah, exactly.
Unfortunately for all of us, but it is low.
Yeah. I'm curious, maybe this is more of an educational question for the audience. It's not always obvious to people when they think about fintech companies offering services to consumers or businesses, what's under the hood? What enables you to do this? Obviously, not everybody who's offering debit cards is a chartered bank. Not everybody's got sort of the regulatory permission to do what they're doing. So there's a stack of enabling technologies and partnerships and sort of relationships that you need to build to be able to offer what you do. Maybe you can start because you guys are a big part of that stack in a lot of companies. But walk people through, let's say, Wealthsimple is an obvious example. Maybe not today because they've gotten bigger, but initially, let's say Wealthsimple wanted to offer their product, or the next competitor to Wealthsimple wants to offer their product. How do they do that? Because they're not on day one a broker-dealer, they're not on day one a chartered bank, they're not. So what enables companies to offer services like that?
Yeah, so one of the important trends for that is what we call banking as a service. I'm sure you're pretty familiar with this yourself at Move, so which is basically a way for an institution that holds a license, like for instance, a bank, a deposit-taking institution, to package that license and make it developer-friendly and offer it through someone else's interface. So if you look at most neobanks, like Koho is not a federally registered deposit-taking institution, right? It's People's Trust that is the core system in the background, receiving, taking the deposits, and they're interacting, Koho is interacting with them in a consumer-friendly way, not developer-friendly way, actually, I should say. And this is a trend that is exploding. Like to your previous question, are fintech tech companies or financial services companies? To me, the answer to this is super obvious. They're tech companies. If you want to see, just take the example of a bank. So you've got basically the front end, which is the interface, the back end, which is kind of the brain with the business rules, and the core systems in the background. So the first and second layer are getting increasingly externalized from the banks. So I just gave Koho, which is the example of a front end that sits completely outside of People Trust, right? If you look at a Wealthsimple, so the middle layer, the brain, there's a lot of robo-advisors out there, right? Instead of a human making the financial decision, it's robots. So you've got financial services being exploded through a whole range of providers, but the one thing that will never change is the very, very heavy regulated compliance for the core systems, but the rest, it's increasingly niche, increasingly wide range of players using increasingly sophisticated tools like AIs to take the financial decisions in place of a human. So to me, fintech companies, tech companies first.
And I don't know who's best positioned to answer this question, but let's take People's Trust as an example. They're one of the biggest names in the Canadian fintech industry in terms of enabling a lot of these fintech companies to offer their services. What's the strategy for them? Why not directly offer a Koho-like experience to a customer? Why enable Koho to do that instead of them doing that directly? Is it a matter of competency, capabilities? Like what is it that?
I'm not their board or their director of strategy, but it's probably just a specialization, right? Koho is a very sexy distribution channel. They're so good at marketing, like everyone wants to download their app, etc. I can be the guy who sits in the background and take a cut. Why not? Basically.
They're the arms dealer. Yeah. Why? I mean, like, if you're the arms dealer, you just, supply everybody and take your fair share, right?
Yeah.
Especially if you can, look, if you're talking about digital banks today, the infrastructure under the hood is some combination of a custodian plus a banking as a service platform plus some KYC AML capabilities. And there's players that do all of those things, and frankly, a lot of that is offered through an API. And when you were one of the OG digital banks, doing that was super, super hard. Now it's not as hard because these APIs are readily available. And when you go and sign up a custodian bank or sign up with a banking as a service platform or go get integrated into an Alloy or a Trulioo to do KYC, nobody pats you on the back for that, right? That's just table stakes to arrive at the starting line to run your business, right? The best digital banks that are out there are frankly the best customer acquisition machines. They offer the best user experience, the best onboarding flow, the best integration between the app and the card, allows you to do a lot of stuff. And then they have very, very disciplined metrics on how they acquire customers every day, every week, every month, right? That's the primary benefit of being a digital bank. Now, for us, we like those companies, but we also like, equally so, if not better, the infrastructure guys. We like betting on the arms dealers because they're the guys who power the infrastructure that supplies all of these, in this case, challenger banks. And Flinks was a good example of that. We think of Flinks as a utility company that powers a lot of fintechs across Canada and now the US, right? There's a whole bunch of payments infrastructure today that's old and outdated, and so we're keen on backing payments companies that can modernize the payments infrastructure to do things like real-time payments or real-time cross-border payments, things like that. So those guys, in our minds, are like the arms dealers that supply the front-end companies whose job it is to acquire customers.
Anything to add in terms of how?
It's really well said. I mean, it's a lot more complex under the surface. I mean, as you said, Koho is not the bank. Float's not an issuer of cards, even though people think we are. And I think part of what we think about is some of those trade-offs are worth it. We're built on a Marqeta. It's been a great partnership for us. It's helped us get to a point in time. And over time, there are certain parts of what we do. I think, ultimately, we want to own the experience with our customer, and one of the things that really drives us crazy is when customers message into support. We have a rule, which is you at Float, you don't blame anyone else. So if a customer complains about something at Float, and it's actually something that's People's Trust's fault or Marqeta's fault, no one says that. We say, our bad, and we're going to fix it. But we simmer over that stuff, and we try to think carefully about what parts of our business do we want to outsource and where there's an adequate solution, and then what kind of brain damage are we going to bring into the company. We do a lot of this in compliance, where as an example for KYB, we used to outsource it and it sounded great, but it never worked, and the customers always had a bad experience, and we said screw it, we'll just do it ourselves. And in some parts of our business we've chosen to do it because it reduces so much friction for the customer that the whatever the investment is, we see much greater ROI. Below the surface, it's obviously a lot more complex.
And what's interesting about your point is that you guys will build better KYB, but that alone is not the thing that drives value for your company. It's the resulting customer experience or customer acquisition that is the thing that drives value.
Yeah. Yeah, totally. But it is true. I mean, there's a lot that goes on. People don't realize it. You know, even though we're not a financial institution, we essentially have obligations that our financial institutions that are our partners have designated onto us.
Yeah.
So they have to do KYB on customers. Our contract requires us to do KYB on customers we put onto their platform to a certain standard, right? And so it's a very fun and interesting process to say, put all that away, look through the lens of a customer, what do they experience, and then over the course of time, what complexity do you want to take on? And interchange and transaction-based revenue models, you know, you have issuer processor, you have a program manager, you have an issuing bank, and then you have a software layer like Float. There's a whole range of activities you could take on. You generate more revenue, but then you have the burden of having to do them. So it's
and some of them with a lot of regulatory overhead and
yeah,
having to build effectively in-house compliance teams.
Yeah, Wealthsimple's going through that now.
Yeah.
So I think it's a combination of pushing partners to do better, and then, you know, occasionally throw up your hands and say, we got to insource this, or it's the right bet for us to insource this because we will now control some part of the customer experience that might be a big decision factor for why a customer picks us versus someone else.
Yeah. Well, especially if your value proposition is like the seamless onboarding experience and how quickly you can get to an account.
I mean, the statistics you can track, you know, it's amazing. You can look at, you know, how long did it take for customers to go through each step of your funnel? What are the median times? What are the average times? What rate do customers drop off at each stage of the funnel? And so you can get really granular and see where this stuff really creates friction.
Yeah, I mean, this is, I don't know that it's the same amount of pressure has shown up in Canada, but in the last couple of months in the US, I mean, you may mention the fact that this idea of like user-facing front-end banks or challenger banks in the US has exploded, powered by a relatively small number of sort of banks under the hood that are, you know, enabling these banking as a service partners. And the regulators just started putting a lot more pressure. And what that has translated to for companies like ours and dozens of other companies like ours is now the banks are more stringent with what they'll say yes or no to, right? So we use everything we do, and just to give a sense of like how these compliance rules play out to a business like ours or to a customer is that, you know, you want to put out a new ad on Facebook or whatever. The copy of that ad, the picture that is in that ad, all that has to go through the compliance approval process of the bank that is the licensed entity under the hood. And it used to be relatively fluid, and the banking as a service companies that sort of enable that in the middle would make that relatively seamless, where you could say, hey, I've got an ad campaign I want to push out next week, you know, give them 2-3 days and they'll give you approval. Now the regulators have started stepping in and saying to the banks, hey, you guys have been too fast and loose with allowing companies that are not regulated financial institutions to start offering services to customers who think that, in our case, Moves is a bank. And it's not often clear enough that the bank is actually called Blue Ridge and they're accountable for anything that goes wrong and et cetera. So now we're starting to see a lot more, I'd say, pushback from the regulators in that context.
My friend, you ain't seen nothing yet.
Oh yeah.
It's, look, we were heavily regulated at Zoom. So Zoom is a cross-border payments company, consumer facing. So you'd come to our website or you'd launch our app and you say, I want to send $200 to my mom in Mexico or the Philippines, hit send, and mom would get her money. And we built all of the infrastructure ourselves. We were the licensed entity. There wasn't a bank behind the scenes carrying the money and running our licenses. It was all on us. And we had money transfer licenses in all 50 states. And we had what are called surety bonds with each state, which means we had to tie up a bunch of our capital with each state in case one of their citizens lost a bunch of money using our platform. Is basically the insurance policy. Then we had every state audit us on a 2-year cycle. We had a dedicated room in our office called the audit room, and on any given day, there were a team of people from some state running their audit on the company. It was an unbookable room, and there was a team of auditors in that room almost every day. And so the point about, you know, making sure your copy is accurate and making sure that what you say in advertising is accurate, making sure you're disclosing all of your fees is accurate and calling out that you make money on the FX spread. Like, we had to deal with all of that. And it was a huge, huge, huge burden. But if you do it well and you make it a well-oiled machine, it's actually a big barrier to entry from competitors trying to do this. Because if you do it well and compliance is part of your DNA, it's super hard to replicate that from your competitors.
Yeah, and this, do we have time for one more? So this speaks volume to how conservative regulators are usually. Like, you know, you've got this one in payments. This brought to mind for me in open banking. You know, when people use an open banking powered product today and they give their account credentials for the robot to get into their bank account and extract the data, pass it to a provider, in most contracts that they have with their financial institution in the background, there's a clause somewhere in there that says you can't share your password with anybody. So technically, they're in breach of that. Based on this, a couple of years ago, the Financial Consumer Agency of Canada issued like mass warnings to consumers, like do not use these fintech tools. You're going to breach your bank contract. As if a contract between a bank and their customer is the law of the land. Like, what if that contract said, don't talk to your mom and don't buy a Honda? Is FCAC going to tell people, don't talk to your moms and don't buy Hondas? It's in your bank contract. No, like, it's an aberration. But it's just the way they're used to see things operate, and it's very counterintuitive for them to move away from that. But to your point, once you're on the good side of that line, in this case, if you're a financial institution who's used to dealing with them and they're used to seeing your contracts, it becomes a competitive mode for this. And you know, to your question about open banking earlier and why it's not progressing that fast in Canada, this conservatism has a big part to play in that.
All right, well, we're gonna turn to audience questions in a second, but maybe one last sort of fun question quickly. So maybe one of two questions. So either one, what would you love to see show up in Canada that exists somewhere else in the context of a fintech product or an app that you've seen in another country that you sort of would like to see an equivalent version in Canada? Or what is the one thing about sort of the Canadian financial services industry that you hate the most? You know, a product, a company, you know, you can go positive or negative here. I'll leave that up to you. I'll start. I'll volunteer my Interact. I hate Interact. I think they should disappear. I think they should be replaced. That's my.
Why do you hate it?
I think just the amount of control they have on a very critical piece of infrastructure and the inability for anybody to offer sort of viable competing alternatives that get creative on like the user experience. I mean, I think Venmo's like a played out example because at this point it's a pretty old tool. But you know, I look at products like Venmo or Cash App in the U.S. The ability to compete on peer-to-peer cash transfers in Canada has become effectively impossible. Because
so you don't hate Interact, you hate the access or the lack of access.
Yeah, okay. Yeah, or yeah, what they represent. I mean,
Look, so I'm just going to react to one thing you said. Look, Venmo is a PayPal business, right?
Yeah.
And this is an example of what I was saying before about geographical expansion. Venmo is only available in the US, but the need for peer-to-peer payments in other countries is clearly there. Interact is a clear example of how much Canadians value peer-to-peer transfer. The only reason Venmo doesn't exist in Canada, frankly, it's a shitty business. Like it just is. Like it's a you know, it's a bit better now, but it's a money-losing business because there's a cost to move money from one person to another, especially if you're moving it from a bank account or from a card to another bank account or to a card. There's a cost to that, but Venmo doesn't charge a fee or historically hadn't charged a fee. So bringing that terrible business model into other geographies and trying to expand would frankly just put a greater and greater drag on the overall PayPal business. So that's why Venmo doesn't exist in other geographies for the most part. And so to the earlier point about, you know, you gotta own your own geography first, and we were talking about that in the context of Canada. The caveat to that is you gotta prove that the business model works, that the unit economics works, that you can then take that fundamentally good business and then apply it to other countries.
Well, you're talking like a VC. I was asking more as a consumer, what product do you wish you had access to in Canada?
Yeah.
But yes, I take your point.
So It's lame, but I have the same as you. And like, I'll phrase it more politically correctly, since, as you said, I need to play both sides of the line. It's not that I hate Interac, it's that I think it's an aberration that are not the company, and hi, Louis-Philippe, and nothing against your employer. But I think it's an aberration that, you know, for the payment modernization process that we have ongoing, like a national, you know, generational initiative, we're picking a private sector player to basically owned by a bunch of incumbents that have very real commercial interests in, you know, the payment sector that they're meant to be reforming. It's an aberration that we're picking that player to do this. Is it a coincidence that it's already been delayed twice? Probably not. How is the end result going to look? My crystal ball, probably underwhelming, right? So that's the one thing I hate. And as a customer, because ultimately, right, these inefficiencies, they get passed down to everyone in this room. And about the product I'd like to see from somewhere else, we didn't touch upon this much today, but I believe a lot in the opportunity of crypto. And I think one of the crucial pieces to accelerate adoption is tools through which you can use it more easily in the day-to-day. So things like the crypto cards we're seeing appear internationally, not the cards that is just like a credit card that gives you a 1% cash back in a crypto asset, but the ones where you can actually spend directly from your crypto assets held somewhere. I'm really looking forward to see that here.
Karim?
I don't know that I would characterize a new product in Canada as trying to steal an idea from somewhere else and bring it here, just because I think that there are like big fundamental issues that frankly don't exist anywhere. Look, to give context, financial services is about 20% of the economy in both Canada and the US. It's a fifth of GDP in both countries. So the opportunity is massive. And a big chunk of that is real estate. Like more than half of that is real estate in both countries. So personally, look, there's areas within payments, there's areas within insurance especially. It's a massively broken industry from a tech standpoint, and talk to any carriers, they'll tell you the same thing. There's opportunity there, but the other big one is in real estate. And like we have an open thesis right now that fundamentally changes the way you think about buying a home. And right now, you've got a buyer, a seller, a buying agent, a selling agent, a lawyer, an appraiser, a contractor, you've got a lender, a mortgage broker, and list goes on and on and on. And usually the process to buy a home is quarterbacked by the buyer. That person sort of coordinates everything. Now, we believe that buying a home should be as simple as buying literally anything else. You choose a property, you say, okay, this is what I like. I want the best rate from the best mortgage provider. I want the walls painted blue. I want the countertops changed to granite. I want different tiling. Click a button and add to cart, ideally. But more realistically, call me when the keys are ready. Oh, by the way, take care of selling my old home and make sure all my stuff is moved into my new home when it's ready. Now, all of what I'm describing are highly non-trivial functions in and of themselves. And we've seen companies doing a bunch of different things in each one of those steps. But what we haven't seen is someone that's doing it across the field to provide that user experience. So to the earlier point, user experience is so key. A lot of people don't care. They don't care about what the underlying infrastructure is, so long as that they experience something that's magical or delightful. You came from Uber, and Uber is like the classical example that I always use, is that You push a button and a car shows up at your door. There's a whole lot of stuff that happens under the hood to make it happen. But for me, I push a button and a car shows up. And we want to try and create that level of delight in the real estate space.
That's a big one.
Huge.
Rob, what about you?
US Netflix. I was thinking for a while here. No, I mean, I think in Canada, it's kind of a really tactical one, but electronic fund transfers in Canada are a real problem. And they're a real challenge for us. So I think that's what we would love.
That's the process of sending money between bank accounts, right?
Yeah. There's a lot of challenges associated with it. I think that real-time rails, I don't even know what that means at this point in time. But it sounds great, and it would be awesome if it happens.
Well, it's like if I want to transfer money between 2 TD accounts, it's instant. But the moment it's TD to CIBC, it takes 5 days, and you have no visibility if it's actually happened or if it's been lost somewhere in the middle.
Yeah, which creates difficult trade-offs for businesses. If you think about what Karim just said, we want to deliver this great user experience. When the third-party providers or rails that you use can't provide that, what do? Do you just say to your customer, you got to wait a week to open your account? Do you step into the value chain and do something for them from your balance sheet? We deal with this a lot for customers who transfer us money. We have very, very difficult, spirited debates about how we should make our own financial resources available to them to mitigate or sort of insulate them from the shortcomings of the financial system. That creates financial risk, there's fraud, so it's a really interesting topic, but again, it all comes back to the customer experience, which is that, and we never want to say this to our customers, because they'll say, why isn't my money in float yet? And we want to be like, we can't control this, this is the limitation of the financial system. So that's a big one.
We built it at Zoom.
Did you?
Yeah, like I said, cross-border payments, and if you send money to another country, it's incredibly slow, and you don't know where you click a button, it goes into the ether. You have no idea whether it's going to show up or if it's going to be the right amount, because there's sometimes a landing fee. So what we did is we opened up bank accounts all over the world. We integrated into something like 150 banks in different parts of the world, and we put money there. So that when Rob comes to Zoom and clicks a button, says, I want to send money to a mom in the Philippines, the money is already there. We pay out Rob's mom in the Philippines, so to you it looks like an instant transaction. Yeah. But in the US, it takes 3-4 days to get the money into our account as good funds. So we took the credit risk. And the reason why we did that is for customer experience. It was shitty to hit a button and then wait 4 days for mom to get paid. So we said, to hell with that. We're going to build it ourselves. And so that's what we did. And the whole motivation was to build that delightful, magical user experience. And nobody else in the industry did it.
Yeah. All right, let's pivot to see if there's any questions from the audience. We'll maybe spend 10 or so minutes, depending on who's got. Yeah, let's start with you.
I'm actually curious what you guys personally think is what is your optimism about the state of fintech in Canada, especially about the market, the regulations, and in your case, the quality of new entrants coming in?
Answering the question that is the title of the panel, what is the state of fintech in Canada? Sorry, bad moderating. I didn't get to the point.
You know what? You're probably a good one to answer this, considering you guys are a utility company and see a lot.
Yeah.
Are we bullish right now about fintech in Canada?
I am. Okay. So, elephant in the room, right? The macroeconomic context, lots of sad news recently, layoffs and techs, and sympathies to everyone affected. I remain bullish. We, as everyone understands by now, we operate basically a data layer powering close to the entire ecosystem, more than 75% of it. The usage is not going down. If anything, it's still accelerating. Our revenue is growing. It's a sign that the financial ecosystem is being used at least as much, if not more, as before, because we're not increasing our prices, right? It's
so
tied
you're
to usage.
Buying Flinks, if you could, is buying an index on the Canadian fintech space.
Indirectly, it kind of is. So I'm personally very bullish. We've seen some exit by some large players in the last years, like the Revoluts, etc. I don't think either that this is a sign that our fintech ecosystem is a bad shape. I think it's a consequence of the, let's call it the tough regulatory landscape, that I alluded to a couple of times. But overall, I think it's doing pretty well, and we'll see it as soon as we're at the end of the current economic turmoil we're seeing.
Yeah, and I think one thing, just to add to your point earlier, Karim, is just like, macroeconomic cycles aside, consumer demand for better, faster, more elegant, more delightful experiences is never going to go away. It's only going to get stronger. So either incumbents
it's going to one place.
Up. Yeah. So the macro trend is people are going to want better access to tools to help them manage their money, to help them manage their portfolios, to help them spend for their small businesses, to help. That's not going away. I think if anything, we're becoming quite spoiled as consumers to expect that like more. And that just means that companies need to build those things, right? So,
look, the way I would answer this question is in two parts. One is this macro environment, and one is the micro environment. The macro environment is, look, fintech. I was explaining this before. If you look at the S&P, it kind of goes up in 2021 and then takes a big fall. If you were to look at the fintech part of that, it's much more exaggerated. It's like high highs and then low lows. And the peak was in October of 21, right? And the low is basically where we're at right now, right? So that's sort of the macro lens of what fintech looks like today, especially in the public markets. Now, I said before, financial services is about a fifth of the economy in both Canada and in the US. A fifth. It's larger than any other single industry in the country, in both countries. Okay, so that's point number two. If that's sort of the macro element to this, okay, and the micro element to this is that there will always be a market for companies that have good, strong fundamentals. In other words, if you're building a product that people want and your cash inflow is larger than your cash outflow, you've got a good business, generally speaking. Now, when we talk about early stage companies, we forgive them a little bit by saying, hey, your cash inflow can be a little bit lower than your cash outflow because you're still growing, you're still investing in your product. But what needs to be true, even from the beginning, is that the fundamentals need to be strong. In other words, your gross margins on your business at a unit level need to be strong enough that you have a durable business long term. Because remember, at the end of the day, when you're 5-10 years into your company, which by the way is about the lifespan of building a startup, the money that you bring in always needs to be larger than the money that you put out. If that's not true, long-term built in your model, you don't have a successful business. And there's always going to be a market for that. So, your question is, there is this macro lens for why financial services is still a big opportunity, especially relative to other industries. And then if you're building a business with strong fundamentals attached to it within financial services, you've got ingredients for success.
Anything to add, Rob?
I think the only thing I'd say is like there's some passivity or like passiveness to the question of like what's the state of the market. I think Canadians need to stop, like even in a regulatory discussion, if someone told Mike Katchen when he started Wealth Simple, like all the things that we involved in getting Wealth Simple to this point, like a rational person could say it's not viable, it's too hard, and look, Revolut pulled out, but this wasn't Revolut's core market. So I think Canadians need to say, this isn't good enough, we're gonna build something. And to some extent, building a startup is reeling your way through a bunch of obstacles that objectively make your business really difficult and saying like, enough, we're just gonna do it. Yeah. And I think Canada is, to the extent we have people doing that, that's a great thing. I think the narrative around regulation and the banks is fine, but I think it can border on like excuse,
Yeah.
I'd say.
Yeah.
I sort of look at it and say, if this improves,
The taxis
great.
didn't want you to show
Like,
up.
it's obviously great. I mean, I'm not involved in politics. Like, you know, for lots of people, this is an important cause. Like, as a citizen or as a voter, it's important. But like, as a CEO, I'm kind of like, my job is to figure out how to make this work, and hire creative people and problem solve, and sometimes pressure partners to change their ways. And no one's going to bring innovation to Canada. We have to build it ourselves.
Yeah.
I actually don't think foreign companies are going to do it here. People ask me all the time because we have competitors in the US. I'm like, why would they come here? Like, are you kidding me? We're talking about all this nonsense in Canada. Why would you come here? I think it's got to be Canadians who say, yeah, no, we're going to build something here for us by Canadians. And I think in some cases that's required to innovate. No one told Uber, that the regulations were open. Uber broke the door open and said, we're here. And they made riders and drivers and everyone that was part of that sort of platform very vocal to change laws and move things. And I think we do need a bit of that in Canada.
Yeah.
Like this idea that a bunch of bureaucrats are going to go into a room and come up with a modern payment system. Like personally, I think it's kind of funny. I think it's more likely to be media pressure and companies really pushing. And
Well, I like Dom's point on open banking. If it doesn't
Yeah.
come from customers, it's not going to come
it's
from
got to come
anyone,
from
right?
customers. So yeah, I'm definitely optimistic, but I think it's got to come from within personally.
All right, any other questions? Yeah, Charlie.
I got one question more directly for Rob, but maybe Karim, you can talk about it a little bit as well. But it seems like you talked about value creation and the fact that you started with a financial product, started charging $5 for the software. You see yourself someday charging $1,000 a month, maybe. What that kind of signifies is you're kind of dancing away from creating value purely from the software product, purely from a financial product, to really what will be like a software platform. And so I would love to hear, like, maybe for the room, like, what are lessons learned on like kind of moving towards that transition, at least in the early days, and like how do you think about tactics that help your customers think about you not just as a financial product to do transactions, but like as a financial platform for their business?
Yeah, well, it's safe to say, or it's worth clarifying, that's not our current vision. I think I was using an example. SaaS today is a small part of our business. It was very small. We made it to be small as opposed to very small. And we see adjacencies in the future, and we're not sure how they'll all play out. I mean, I'm a pretty blunt, candid person. There's some amount of crystal balling you can do, and then there's some amount of let's stop crystal balling and build our business and reevaluate these things every board meeting and talk about them and collect data and read books and follow other companies, and some of this stuff we'll learn. The biggest lesson that I've had leaving Uber, I was at Uber, the early days where it was all good, then I was there when it was all bad, and then I was there when it was, okay, the new Uber, And one of the biggest mistakes that we made at Uber was failing to recognize the role that human psychology plays in pricing, and that had a profound impact on both the product team and Float Uber internally and our customers. So the best example would be, we'd say in a city, drivers need to make a certain amount of money per trip, and we're not going to be at that level of efficiency, so we'll pay them these subsidies, and the models will say that we'll pull them off. And I built these models in Eastern Europe, and we'd run them. But then something funny happened. After a year of paying subsidies, it turns out it's actually hard to stop charging them. And most people who have been using Uber Eats and a lot of these apps probably realize that delivery fees have gone up. And I think it's really one of the things we've done at Float is we are charging for our product today, not because it generates revenue for us. In fact, it's almost inconsequential, but because we said, if our customers aren't willing to pay for our product, maybe we don't have a business, and we'd rather figure that out now. And that's actually really valuable feedback for our product team. And as a manager, I also think it's important for our team to learn how to sell that. Because our sales team would say, ooh, we have to charge, then we'll close fewer deals. And I'm like, well, that's how that works. We got to learn how to sell. And if it doesn't work, then we should build a better product. But if it does work, then we got really valuable feedback from the market. And I think tech companies now, startups, are very shy about charging for products for a variety of reasons. The only advice I would give, I don't have any crystal ball, is to consider the reflexivity of what you do. Most companies, if you take a path on certain policies of how you price your product or what you do, customers are going to associate you with that forever. And so you should consider or to some extent forever. And so, we're trying to be thoughtful about having a fair deal with our customers and being open and comfortable charging for some features that we think are worth charging for. And then being open-minded when we launch new products. We'll have new ones in 2023 that don't generate any transaction revenue, but they're better for our customer. They'll make our platform stickier. They may cannibalize our interchange revenue, but our perspective is that if we don't do that, someone else probably will, and that creates other opportunities for revenue generation, down the road.
Appreciate that.
Sure.
Nothing to add, Karim?
The only thing I'd say is the business model that you choose, regardless of which business model you choose, you need to be hyper aware of the value that you're providing and correlate your business model to that value. Because if you're charging for the wrong thing, you're not gonna make any money, right? And Charlie, your question was about this transition for usage-based into a SaaS model or going between the two. We have a portfolio company that actually did this. It's a company called Pluto, and they do B2B payments. That's what they do today. Their bigger, grander vision, which they are actively building out right now, is to be this like mission control for the finance team of small businesses, right? So you coordinate all of your cash flows, any treasury functions that you have, perhaps a credit facility, all of these different elements, it becomes this mission control. Now, previously, they were charging per transaction only. So you'd only pay if you send, or if you process a transaction. I think it was, not last year, maybe the year before, they decided to say, hey, we're actually gonna charge a $25 SaaS fee per month to all of our customers. And holy shit, were they scared, right? Everybody held their breath and said, oh my God, we're gonna see so much churn. Nobody's gonna like this. But we feel like it's the right thing to do because we add value in this way that allows us to be seen as a platform as opposed to just a transaction-based business. They held their breath, they did it, and almost nobody churned. Like they retained almost 100% of their customers. And so now they've set this precedent that we are a platform, we charge you for usage of our platform, and on top of that, we charge you for the transactions that you process through our platform. So they're an example of a company that's made that transition successfully, but they did it because they understood the value that they were providing in order to do that. But they were scared as hell when they did it.
Maybe one last quick question and then we'll wrap up if there's another question in the room. All right. I think we'll call it there. We covered a lot of ground. Thank you so much for being attentive for just over an hour. Hopefully you learned something. To the extent you want to stick around and have a drink and chat, most of us will be sticking around. And hopefully we'll see you on the second edition of the State of Fintech, or maybe we'll come up with a better term to Rob's feedback. But, the Fintech opportunity in Canada is maybe a more optimistic way to frame it. Thank you for being here.
Thanks for hosting me.
Yeah, pleasure.